much, Sichen. Now we're going to move on mic to the BCC Global's two founders here. So please let me introduce Chang, Zhao, and then Ted Lin. So I'm going to have a very first question to Chang. Chang, as a head of a global consulting firm's founder, my question is, I mean, you led recently very successfully the GAIC project, very reputable U.S. healthcare company, and then they're benchmarking on China. So what was your take on that, and that project, and how would you see the, U.S. and China trade wars going to impact the healthcare industries like this, as an expression of? So for Ted, and then, I know you have a background, and you're coming from the background, the Bessemer venture partner, and then I know you made also like a lot of investments in the past like this. And how would you see that this pandemic situation is going to impact the VC industries in China? This is my question. So start with Chen. Please briefly introduce yourself and your company, and then please move on. Thank you. Right.
Hi guys. So my name is Chang Zhao. So I haven't been in China continuously quite as long as Will. I came to China about 2000, right after graduating from Stanford. So only about 20 years. But, to my defense, I was from China originally before going to the US. So maybe that counts for a little bit too.
I have further backed up.
Right. So my company, Business Connect China, has been serving U.S. and South Korea and European investors in China for the last 10 years. We're primarily working with investment firms such as hedge funds, mutual funds, PE and VC investors, as well as consulting firms. Most of the multinational consulting firms, as well as other houses, use us as a regular tool in their repertoire to find out and engage more with their Chinese counterparts and to understand Chinese industries more thoroughly. So getting back to Winston's question, the insights that we have from working with this type of cross-border market research collaboration project is that one, we do think that the barrier exists, right? So there is definitely going to be a barrier between China and US. I think everyone on this call has mentioned it. Most of us has accepted it. But I want to comment on the directionality of this barrier, right? So far, I think the barrier mostly is one way. So I think from what we can see on this project, and I think it makes sense, is that the US right now is actively engaged in limiting or at least checking part of the growth of their Chinese counterparts in terms and in fields of high technology, STEM, etc. However, as also evident in this type of project, I do not believe that US companies are of the same mind as the US government. US companies, by and large, still see China as a very reachable market for their technology and their tools, and certainly one of the largest single unitary markets in the world that they would like to exploit. What does that mean for the future of the two countries? I mean, while not having a crystal ball, we can only say that by the current look of things, I mean, and I think this is mentioned by all of the respondents during the session, is that we do not think that this is going to get better, right? So if the source is coming from a position of mistrust, and in this case, mutual mistrust, it's certainly likely to lead to more bifurcation and segregation of the two economies and the two peoples. But in terms of capital utilization, it certainly also creates interesting arbitrage opportunity when the world is getting smaller and smaller and globalization ultimately becomes more limited. So, yeah, and that is in a very short gist, our view on this sector of the economy.
Oh, thank you so much, Chang. And we're going to move Mike to Chang's partner Ted Lin here. Hey, Ted, how are you?
Good, Winston. How are you? It's
Good.
great to hear from all these panelists. I think, as other panelists mentioned, there are opportunities, and given that there are some U.S. pension funds where their mandates are investing less in China, that creates probably a better opportunity for other LPs elsewhere from the U.S. While there are U.S. investment funds who are slowing down on investment in China, our experience is we actually see quite a few U.S.-based hedge funds and private equity firms and VCs going against the trend and trying to invest more in China. But my advice is this, right? If you want to invest in China, you don't want to do it yourself. You want to put money in like local team who understand local environment very well. Right? So the best performing VCPs are the local ones in China. And in case of Marathon Venture, I know the founder of Marathon Venture, Ray. He has been with the best PE funds in China and VC funds in China for many years. And he has a team of local people who invest very well. And the good thing is he actually hired somebody like Will to work with him and communicate with investors outside of China. I guess Ray can deal with the investor in China, and Will can do that outside of China. And if you look at the best investors in China, Sequoia, Qiming, they all have similar, where they have somebody who is very well versed for investors outside of China, but they are investing very, very well in China. So my advice, don't do it yourself. Find somebody who you can trust, who understands China well, and make them make money for you. That's probably the best advice I can give you. And how do you find out if a fund is trustworthy? And that will be something that BCC and others who have been in China for many years can help you. Right? I think everybody wants to get into, say, Sequoia or Qiming or IDG, but a lot of times they probably don't have enough opening for everyone. In that case, you might want to find somebody like us or people who know China well to point you to the right person who understand China well and who can invest well in China. And there's some gem in the rough, right? I think Tai has been in China for many years too. And these are all people who understand China very well. And so leverage their understanding on the ground and have them make money for you. By the way, I know China has been an interesting word, where there are people who think of it as a big market. There are people who think of it as a very risky market. And it's both. And usually risk equals reward. So if you are willing to take some risk, I think there is a chance of getting a tremendous return. You just have to manage your risk very well.
Okay, Ted, thank you so much here. So we already listened to all of the foreign professionals. We're putting a mic on Korean professionals. So first of all, I would like to introduce Mr. Yu. Mr. Yu, please introduce yourself a little bit, like probably 1 minute, and your past histories of financial industries. And as a first start of the interview, Mr. Yu, could you tell me a little about like why Korean investors are putting so much conservative approach on China asset? why is this? Is that because, like, we South Korean investors do not understand China very well? So just like other professors said, U.S. investors are pretty much on the good stage with these portfolio companies in China. So could you actually tell me a little bit more about that? So Mr. Yu, please put off the mute button there. So, Mr. Yu.
So thank you again, Winston, and thank you for having me. As to myself, I just came back from Beijing last November, and I have served at Asian Infrastructure Investment Bank. I have been in the government, but in my separate personal capacity, I have found the Korea's China Capital Market Society, where the Korean experts on China market gathered for more than 10 years now. And I'm proud to be a founding chairman of the society, and we continue our endeavors to study and observe China's capital markets, including PEs and VCs, which are today's topics. As to your question, I just wanted to share my observation. First, I would say that the conservative approach to China assets did exist in Korea even before the COVID-19 crisis among institutional investors, and it has been worsened during the crisis now. Their hesitation is well contrasted, though, to the rapid change in their investment policy in favor of overseas investment as well as alternative investment in general. There are several internal and external factors that they have continued to general conservatism over investing in China. As to internal problems, I would first point out that there is still a significant gap in information, business network, and in-house capacity that has not been well bridged by financial intermediaries and experts in Korea. The values and risks in Chinese investment opportunities are not fully monitored and analyzed. For example, there is no Korean brokerage house in China operating with a full license, and only one Korean asset management company is licensed to date. The second, the Korean investors, both retail and wholesale, have largely bitter memories of suffering losses in Chinese investment products due to incomplete sale or accounting frauds from even early 2000s until recently. They include China equity funds, debt products, and several IPO stocks. In addition to these underlying problems, we are facing a big uncertainty of the Chinese economy ahead, which is, by the way, the most important trading partner to Korea. VC and PE sectors in China are no exception. The bright side of the story, though, is that all the financial investors are not all the financial investors are overly sensitive to China risks in Korea. They clearly understand the values and opportunities in investing in China, particularly through PEs and VCs. The challenge is how we can turn this encouraging sign of differentiated appetite for China assets into a meaningful investment stream, if not a mainstream, among investors, so that they could develop a more diversified portfolio in short and a long term. Thank you.
Thank you so much, Mr. Yu. Appreciate your comments. I have one very good question here. I think it's a very good question. So, Mr. Yu, I remember you met the Vice Premier of the People's Republic of China, Liu He, not too long ago. And then I understand that you have a long years experience of dealing with financial professionals from South Korea and also financial professionals from China elsewhere. People say China is probably a better country when it comes to investment freedom if you compare South Korea. And what do you think about this? What are the two countries' biggest differences when it comes to investment?
Well, that's quite a big question. Yes, I had a chance to serve at the International Advisory Council of the Chinese Securities Authority the last 4 years. And also, it's more than 30 years that I have been in the government, is doing the securities market largely. But I see first the common grounds of two countries' capital markets. Basically, it has a character of developing market characteristics. Having said that, their economic regimes are way different. Having said that, the Korea's experience in developing its capital market and in coping with the financial crisis, starting with the Asian crisis and global crisis, and even current crisis, China and Korea can find a lot of common grounds to learning each other. I'm focusing on PE and VC sector. As far as I understand that the Chinese capital market authorities are in a way very consistent in pursuing three policy goals. Number one, obviously the capital market stability. The second, continued market system reform, if you like. And then thirdly, the market opening for foreign players. They have been confirmed the recent policy stance at the onset of pandemic crisis. So I'm pleased to find that the kind of consistency is being kept by the Chinese authorities. Having said that, they also harnessed the market reform in terms of multi-layered stock market system, in terms of liberalizing IPO's approval system, starting from the board, the venture boards. I think that is a very encouraging sign for VCs and venture firms in China. Lastly, I want to mention on the PE sector and the related policy of Chinese government. We are no longer talking about deleveraging or supply side reform. Having said that, the private equities are very essential, instrumental vehicles so that when the corporate restructuring and cleansing non-performing loans are required, the capital market vehicle through private equities are very much useful and effective even compared to the direct government intervention at the later stage of corporate sector restructuring. So let me finish reiterate my belief that I have gained during the crisis time in Korea, where I found that private equities based on market principle through the capital market system can help the corporate sector, some part of which is under significant financial stress in China, will play a greater role in future. And I expect more policies would come out from the Chinese government. Thank you.
Thank you so much, Mr. Yu. I know you experienced the 1998 Asian economic crisis and then 2000 Lehman Brothers. I think this is a very, very good comment. Appreciate it. So now we're going to move a mic on Mr. Huang Lee. Huang Lee, the CIO of one of the largest pension fund, teacher funds here, private school teachers fund. I think Mr. Lee has quite a bit of questions on these foreign professionals here. So Mr. Lee, could you introduce yourself a very little bit and move on your questions to these panelists, please?
Thank you. Hello, everyone. My name is Huang Lee. I am the CIO of Teachers Pension Korea. And I'd like to say many thanks for having me in this seminar today. Briefly about our organization, the Teachers Pension Korea is the second largest pension funds in Korea with asset size of about $20 billion US. We invest in financial assets categorizing 6 different asset classes, which are domestic bonds, global bonds, domestic equities, global equities, domestic alternatives, and global alternatives. Out of them, we will keep increasing the proportion of global equities and global alternatives in coming years in accordance with our long-term strategic asset allocation plans. Regarding the alternative investment in China, like many other Korean institutional investors, we have been taking a very cautious stance yet. However, we believe China is the country with tremendous investment opportunities, and we're keen to find more investment opportunities in China going forward, especially in VC and PE sector. Today, I have two questions. One is for Mr. Tai Lin from Proterra Investment Partners, and the other one is for Mr. Willie Plummer from Marathon Venture Partners. Okay, first one for Mr. Tai Lin. Some people say that governance issues in the private sector have been improved a lot in China, which could reduce the concern of foreign investors. Can you please give your opinion regarding how the governance issue improved in China and give us some examples, if any? Can you give me answer first?
Thank you, Mr. Lee. It's very nice to meet you. So I first started to look at China 18 years ago. And back then I remember that there was a very famous Wall Street Journal article, and the headline was "The Most Dangerous Job in the World." And it describes how being a board member of a Chinese company listed in the US has the highest chance to land you in prison one day. And you know, that immediately gave me a very bad impression. Now, over the years, and especially over the last 10 years, where I've been in China a lot and all the time mostly, I've seen really a lot of change. As you know, there has been a political crackdown. You know, you can argue whether it's politically motivated or not, but no matter what, it has raised everybody's attention. And these days, I think the new generation of leaders, they are very careful and very aware of the bad reputation that the previous generation created. And so these days, I would say that everybody that invests in China has that fear alert. And as a result, everybody is always watching. So I would honestly say that things have improved. They are by no means perfect. And so what we, for example, like to do when we make investments in China is only one of three things. One is we only own the majority in the company. And you know, we might put our people in or might be in the owner. So we only do that. Or we build the companies ourselves from scratch so that we can set up all the control systems the right way. Or if we are a minority shareholder, we are always the largest, the first, the most influential. But that, you know, out of our less than 10 investments, only 2 we are minority, everything else we are majority. And so this is our way of trying to control it. But from a macro perspective, to get to your question, I think it is true, and I'm seeing on the ground that things are better, but by no means perfect.
Okay, thank you so much for your answer.